This is what I've realized after analyzing 1000 of my own trades. What separates the winners from the losers has nothing to do with luck, intelligence, or even experience. It's something far more practical. It's something anybody can learn. So in this video, I will share with you the 5 lessons that completely changed the way I trade. Lesson number 1. One of the most eye-opening realization was this. My best setups only had a win rate between 30 and 45%. At first, this seemed like a failure. Should you not win with a profitable strategy more than 50% of the time? But here is a twist. Those trades weren't just wins, they were massive wins, earning me almost 5 times the amount I risked. The key to success is not about being right more often. It was making way more when I was right. Beginners obsess over win rates. I think that a high percentage of winning trades equals success. But this mindset ignores a bigger picture. Risk to reward ratio. A strategy with a low win rate can be highly profitable if you have the right risk to reward ratio. So if you risk $100 for a trade and aim for a $500 win, you only need to win 1 out of 5 times to break even. That's a win rate of 20%. Anything beyond that is pure profit. In my trading, I have learned to prioritize setups where my potential reward is at least 4 times the risk, even with a lower win rate. These trades consistently deliver results. Lesson number 2. When I analyzed my 1000 trades, there was one key pattern that emerged. The majority of my losses weren't from bad setups, they were from bad decision making. Emotional trading, that was a culprit nearly every time. It was FOMO trades, revenge trading, or trying to hit home runs to recover from a red day. Letting my emotions take the wheel led to consistently poor outcomes. Emotions like fear, greed, frustration, they are the silent killers of your trading account. And they show up in different ways. First, FOMO, the fear of missing out. That is jumping into trades too late without proper analysis because you're afraid of missing the move. Then there's revenge trading, is entering impulsive trades to win back the losses. Then there is over trading, taking too many trades and you're frustrating, often leading to more losses. And then the home run mentality, ignoring your plan and taking unnecessary risk, a risk to recover quickly. When you let your emotions drive your decision making, you're no longer trading based on a strategy. You're just reacting to the market. And the market always punishes emotional traders. Bulls make money, bears make money, but pigs, they get slaughtered. If you want to fix this, there are a few things you can do. First, have a plan. Always have a plan before you trade. Your setups, your entry and exit criteria, and risk limits. If a trade doesn't match your plan, don't take the trade. You have to recognize your emotional triggers. Learn to identify the moment when you start trading emotionally. For me, it is quite simple. It happens when I'm down on the day, I start looking at my P&L, and all I want to do is to break even for the day. So right now, I just close my P&L. I don't look at it. And when I feel the urge to look at it and I look at it and it's like, okay, now it's game over. Because that is the moment where I start trading my P&L and not the market. When you feel the urge to overtrade, ask yourself this question: am I trading emotionally or am I trading my plan? If the answer is emotions, step back, take a breath, reset. Trading isn't about reacting, it's about shooting. If you let your emotions dictate your trades, you're constantly fighting an uphill battle. The moment you recognize that emotional trading starts creeping in there, stop, reset. Remember, one disciplined trade beats 10 emotional ones every single time. Lesson 3. In my 1000 trades, I noticed a frustrating pattern, a strategy that was working perfectly for months. Shorting pops suddenly stopped delivering results. At first, I refused to accept this. I kept forcing trades, convinced at one point it will turn back. But the market had changed and my strategy no longer fit. And when I sidelined this strategy and started only focusing on A+ setups, and then my results immediately improved. Markets, they are always changing. A strategy that works perfectly in one market environment might fail miserably in another market environment. A shorting strategy might work perfectly in a volatile bear market, but will struggle in a bull run. Momentum setups might excel in high volume, strong trends, but fail in choppy, low volume conditions. The traders that succeed, those are the ones who adapt instead to hold on what used to work. Recognizing when to pivot or when to step back can save you from unnecessary losses. That's why it's so important to track your trades over time. If you do not have the data, then you have no idea when to change. When do you know when a particular setup isn't working anymore? What are the rules when you have to re-evaluate a certain setup? And then identify what setups work in the current market environment. If something isn't working, step back, analyze the market. Trading is about syncing with the present, not the past. Lesson 4, after several amazing months, I hit a drawdown, a big drawdown, a string of losses that eat a chunk of my profits. Instead of stepping back, reducing my risk, I panicked. I traded more, sized up, and took setups that weren't even close to A+ quality. The result? The drawdown got worse. My confidence took a huge hit. It was not until I sized down, simplified my approach, and only focused on the best setups then I was able to rebuild momentum. Drawdowns, they're inevitable in trading. They test your discipline, test your emotional resilience more than anything else. The instinct for many traders is to trade their way out of the hole by taking bigger positions to recover faster, overtrading just the hope to hit a home run, or chasing subpar setups out of desperation. But this reactive approach usually just compounds the problem, leading to more losses. The counterintuitive solution is to slow down, trade less, and focus on quality over quantity. So this is what you have to do in a drawdown. Shrink your position size, even if it feels frustrating. Smaller trades reduce emotional pressure and give room for clearer decision making. Number 2 is limit the numbers of trades. So you focus on high priority setups. And then stick to A+ setups only. Define clearly what is your A+ setup. And number 4, take time to review your trades. Identify what is going wrong and then adjust your approach. Because drawdowns, they're not the time to push harder. They're the time to reset, refocus. Treat them like a pit stop in a race. Slow down, refuel, and reassess. The goal is not to recover everything in one trade. It's to rebuild your confidence and your momentum over time. Less is more when you're in a drawdown. Now, lesson number 5. One of my most impactful moments in my trading journey is when I started to calculate how much am I paying for my mistakes. Literally paying for my mistakes. Revenge trading, impulsive entries, ignoring stop losses, adding all of these up came to a shockingly high dollar amount. It made me realize every emotional or undisciplined decision wasn't just a mental slip, it was a direct hit to my account balance. I started valuing discipline more than anything else. Many traders, they overlook the financial consequences of their mistakes. When you actually quantify the cost of trading mistakes, like revenge trading, chasing trades, breaking your rules, it becomes painfully clear what is holding you back. Understanding the real cost of these mistakes helps you to take accountability and make smarter decisions moving forward. Track your mistakes in a trading journal. After each trading session, if you violated a rule, write it down. Calculate how much each mistake is costing you. Use this data to stay disciplined. Your goal is not to make as much money as you can, but have the least amount of dollars taken away by violating your own rules. Because mistakes aren't just a part of trading. They're a costly tax on your account. The moment you start tracking and owning your mistakes, you regain control. Think of every discipline trade as money saved and every emotional trade of money wasted. Your account balance will thank you. If you found this video helpful in any way or form, hit the like and subscribe button. And I'm launching my newsletter, so click the link below, subscribe to it. It's free, you get exclusive insights. See you there.